Hey guys, and welcome to the Vertex Investing Basics of Forex Trading. Now, just a quick disclaimer, we're not going to be covering absolutely all the basics in this, and we're not even going to go that in depth in them. It's just going to give you enough knowledge that you can continue on with the rest of the course, pick a strategy and go from there. If you do wish to learn everything about Forex, personally myself, I don't know everything about Forex, but I know enough to stay profitable, and that's all you need. Some of the students in our group may even know more about Forex than I do, but that's not the point. So yeah, if you do wish to learn everything about it, go to babypips.com. It's completely free. You can go through all the content on there. But if you're interested in making money and you want to know as little as you need to make money as possible, then this is going to go through it right now. We're going to start with pairs. Pairs are what we trade in Forex. If you don't know what Forex is, it's foreign exchange. So essentially we're exchanging currencies between each other. Similar to going to the exchange bureau, when you swap cash, when you're going on holiday, those sort of things. So there are two currencies that are put against each other to give us a pair. Pairs traditionally look like this right here, GBP, JPY. And this is the Great British Pound versus the Japanese Yen. So pairs explained. This on the left is always the base currency, and the one on the right is the quote currency. So essentially, if the strength of the base currency increases versus the quote currency, this means the value of our price will increase. If quote currency increases versus the base currency, this means price will decrease. It's essentially how much of the quote currency you can buy with the base currency. So in this example right now, at that time, you could have bought 134.2-ish Japanese yen for every £1, okay? So this is basic exchange rate, like I just said. It's very simple, very straightforward. This paragraph right here about the strengths, that'll come more naturally when you think about it and you go through it. But yeah, essentially that's what it is. It's exchange rate. Say if the Japanese yen becomes more expensive, then you're going to get less per £1, right? So we'll go through next. Position types, there is a long and a short. Long is buy, as you can see, and short is sell. You're expecting price to go up like we just said before. So you're expecting the base currency to become stronger in comparison to the quote currency. And the opposite goes for the sell. Yeah, that is the exchange. Basically, you're expecting the exchange rate to go down or up. Not only are we able to make money from buying, we can make money from the price going down. So we don't technically, people seem to get this confused all the time. It's not like stocks where you buy low and then you can hold for as long as you want and then you sell, or it's nothing like that. In theory you buy low, sell high, but we have different ideologies behind it. So this is often a major confusion amongst beginners. We'll go through it a little bit more in the future. Two major trading types. We have technical analysis, which is using charts and anything along those lines, indicators to use and predict price. Fundamental analysis, which is using economic and news events for predictions. These are the two types of traders that we usually have. You may hear mechanical being thrown about, which is more rule-based technical trading. But yeah, styles of traders. There's three main trading styles: day trading, scalping, and swing trading. Day trading being in and out of trades within the day, as it's in the name. Scalping is again in the name, scalping short-term trades, in and out quick. Ideally, you'd be looking for trades between minutes to low hours, maybe 1 or 2 hours. Swing trading, holding trades for long periods of time. This can be hours, days, weeks, potentially even months, depending on the trade. Now, again, positions explained. As we mentioned about trading styles, it's important to mention how positions actually work. Yes, we can buy and we can sell, but we don't just get money once we buy or sell. We have to enter positions that we're able to hold. The further price moves in pips, which we'll explain in a couple slides time, in the direction of your trade, the more money we make. So essentially, if we entered a buy and the exchange rate or price increased, the more it increases, the more we make, and vice versa for losses. The more it decreases, the more we lose. Making money. So how do we actually make money? To make money, we use a broker, and basically these guys are the middleman between us and the market. To place positions and access the market directly, we must use a broker. This allows us to leverage our money. Again, I'll explain that in a minute. Make significant returns from the market and loss potentially. But most regulated brokers, in fact, pretty much all regulated brokers allow you to only lose your deposit. So you don't have to worry about losing anything more. You're not going to be in debt. You're not going to get anything like that. You're not going to get some taxman come towards your door and steal your car or whatever. So yeah, what's a pip? Pip is a fraction in price. To work out a pip, it's the fourth number after the decimal place in price. For example, here GBP USD price can be shown as 1.24755, and the pip is the 5, which is right here. The first 5, I shouldn't have used 2 5s, but yeah, this one right here is the pip. If this number moves up 10 pips, price would now be at 4855 instead of 4755. Hopefully this makes sense. If not, take a note, go through it, and just try and understand it. In JPY pairs, this is where it gets slightly confusing. This is the third number after the decimal place. This will make more sense in future examples as we get into it. And there's also a way where we don't really need to calculate pips ourselves, but again, we'll get into that in the next part of the course. What's a lot? A lot is what we use as stake in Forex. Essentially, 1 pip is a monetary value depending on your lot size. So if you're thinking about gambling, then 1 pip is indeed, I don't know, like your odds, for example, and your lots are your stake. So if we use 1 standard lot, which is quite a lot, especially as a beginner in Forex, you won't be using 1 lot, you'll be using 0.0345, potentially up to 0.5. Depends how much you put in. Again, we'll get into this in the future. Each pip we profit/lose is worth $10 in general. Now, each pair has a different pip value, but the general consensus is it's around $10. Different currencies have different pip value, like I've just said. Say if we were in a long position using 1 lot and price moves 20 pips, then we now technically have profited $200. There are other factors that can affect the profit, and lot sizes can depend on your account size and position sizes. But we will go into what actually gets included into your profit calculation in just a moment. So, spreads and swaps. Spreads and swaps are broker fees. Essentially, the broker takes commissions for us to use them, as they are otherwise free. In general, you can get premium accounts, pro accounts, etc., etc. A swap fee depends on the broker, but the longer you hold your positions, the more swaps you pay. This swap fee is also based off your lot size. So if you had a smaller balance, say £500, your swaps aren't going to be that big no matter how long you hold. Maybe it's a couple pound, if that, pennies. If you had a £100,000 account and you were using higher lot sizes, then of course your swaps may be higher than some smaller accounts. Spreads are the cost of transaction. These vary throughout the day, and different pairs have different spreads, but we'll go into more detail as we start looking into actually taking trades. These fees are completely controlled by brokers. The better the broker, the lower the fees. Again, if you have premium accounts, these tend to be better, as you'd expect. Spreads can be very annoying to trade with, where swaps you don't often notice as much. So, picking a good broker. These are the things that you must look for. If you are looking for a broker, we have an Our Links section in the Discord. You can sign up using one of those links. We do get a small commission from it, should you deposit into it. But if not, you can do your own due diligence and find your own broker. What you want to be looking for is low spreads, low swap fees, fast customer support, quick transactions, reputable, regulated, and make sure you look at their reviews. But other than that, this is the end of this first episode. These are the basics that you need to know before we go into more detail. The next episode will be looking into more charts and start sort of defining more of the basics.